All right, I'll give everyone a few moments to get settled here. Well, hello everyone, and welcome to the panel, What Will Lending Look Like After COVID, hosted by the Canadian Lenders Association. I'm pleased to welcome our panelists today. We have Andrea Federer, EVP and Chief Marketing Officer at GoEasy, Lawrence Krimker, CEO of Simply Group, Wayne Pauman, CVP at Canada at Affirm, Lila Kanji, Head of Asset-Based Lending at BMO Financial Group, and we will have Clayton Feek, Chief Revenue Officer at Flinx. So Lila, as our moderator today, will take us through a panel discussion, and then we will be accepting questions live. So remember, at any time, please submit your questions, and hopefully we'll be able to get to them after the discussion. And as always, this panel is being recorded and will be emailed out to you all afterwards to rewatch. So without any further ado, I'll hand it over to you, Lila, to get the discussion started.
Thank you, Danielle. Good afternoon, everyone. I'm Lila Kanji. I head up Bank of Montreal's asset-based lending and specialty finance segment. As part of our specialty finance segment, we focus on providing a full suite of banking services to lenders, both here in Canada as well as in the US. So despite the economic instability and uncertainty that was brought on as a result of COVID, it is really remarkable to see that lenders have not only managed to navigate well, and in many cases, but they're also been able to thrive over the last 12 months. So now with vaccines being rolled out and the end of COVID near on the horizon, I think this is a good time to be talking about what lending will look like after COVID. I'm extremely excited to be moderating this panel, which comprises of leaders of Canada's fastest growing lenders, as well as service providers, and hear from them on what they expect the environment to be, as well as some of the opportunities and challenges to be in the near future. With that, if I can ask the panel members to, I guess, Danielle's already introduced you, but provide a bit of a background or a snapshot of their company, that would be great. So Lawrence, over to you to kick it off.
Awesome. Thanks, Lila. And hey, everybody, thank you guys all so much for joining us today. I'm Lawrence Krimker. I'm the CEO of Simply Group. Many of you guys may recognize our consumer-facing brand, Snap Financial. We're one of Canada's largest and fastest growing non-bank consumer lenders, and we have a specialty focus on the home renovation sector. I'm a lifelong entrepreneur. I started my first company at 14, and funny enough, I've always been in the home renovation space. In 2013, I built what became a national leading HVAC company, which grew to 70,000 customers. And in 2015, we pivoted that business into consumer finance. Since then, we've completed 13 acquisitions to get us to our level of 200,000 customers today, 450 employees. We have about $1.5 billion of assets under management, and we're growing at about $500 million of origination every year. For us, culture is super important. My team and I are extremely proud to be listed as one of the top 50 best places to work in Canada for the last 6 years in a row. And this year we were graciously awarded the best place for females in the workplace. On a personal note, I'm super active running our charitable arm, Simply Cares, which has raised over $500,000 for youth homelessness, in addition to several other notable causes. And I'm excited to be here today. At Snap, we have an interesting perspective into both consumer lending and consumer spending, specifically on home rental projects, along with new housing starts. So hopefully I can add some value to the conversation today.
Who wants to go next? Andrea, do you want to go?
Sure, happy to go next. Thanks, Wayne. I'm Andrea Federer, and I am also thrilled to be here today. Really looking forward to this discussion with this amazing group of panelists. I am GoEasy's Chief Marketing Officer, and for those of you who might not be familiar with GoEasy, GoEasy is Canada's leading provider of leasing and lending services to non-prime Canadians. So there's about 9 million non-prime Canadians in Canada, most of which can't get financing from banks or traditional lenders, and that's where we come into play. And our mission and vision is really to provide access to credit for these Canadian consumers today while we help them rebuild their credit and ultimately graduate back to bank rates. And so that's really what we're all about. And we do that by offering a variety of products and services to our customers, all of which help them rebuild their credit. We offer free financial education as a way to ensure that they can really improve their financial understanding and make sure that they're doing things to really help build their future and improve their financial future as well. In my role, I am responsible for all of our brand and advertising, digital channels, our product, customer experience, communications, and also our point of sale financing. So excited to be here with Lawrence and Wayne today, talking a little bit about that as well. We are an omni-channel business, so we've got about 400 locations across Canada, and that's a combination of Easy Home stores and Easy Financial branches. We're at about 2,200 employees today. We've originated over $6 billion in loans, and really excited to share some of our perspective in terms of what we've seen over the past 12 months and the outlook for the future post-COVID, which I know we're all pretty excited about. Wayne, I'll hand it over to you.
Perfect. Thanks. So Wayne Pauman here. I'm the head of Canada for Affirm. Up until the 1st of January, I was the CEO of PayBright, which was acquired by Affirm recently. So we're about 4.5 months past the acquisition. We're well into integration now. Affirm and PayBright both had pretty much the same business model, which is we're buy now, pay later companies where we're consumer lenders, but we're point of sale lenders. So we partner with merchants, whether they're online retailers, in-store retailers, and provide those customers with installment loans to buy what they want or need from our retail partners. And so you can find us in Canada at retailers like Hudson's Bay, Wayfair, Samsung, Sephora, Peloton, and everything that we do is a simple, transparent, easy to understand installment loan. It's not a credit card. So there's no revolving interest, there's no deferred interest, there's no late fees. Everything is a very simple installment loan delivered in a fast and easy checkout experience. On the Canadian side of the business, we have about 8,500 merchant partners, and we've interacted with, we've approved over 700,000 Canadians to date.
Great. Thanks, Wayne. I think we've got Clayton. Clayton, you want to just give a bit of a background on yourself as well as Flinx?
Sure. Sorry I'm late. Leave it to the technology person on the panel to not understand how a Zoom meeting is set up. But yeah, so happy to be here. Flinx is a data company. We like to say that we're building the financial data layer of the internet. You might say, what the heck does that mean? Well, it means that we've built technical infrastructure that allows consenting individuals and businesses to share their financial data in an easy, secure, and reliable manner. And also we have analytics that help our clients power processes and new financial services. So we're the market leader in Canada. We're growing rapidly in the US, and we have plans to expand elsewhere in the next 12 months. I've, just a bit of background on myself. I've always worked in data and analytics, primarily in capital markets with Thomson Reuters, a startup called Quandl, which was sold to NASDAQ, so within NASDAQ's data division as well. And the really interesting thing for me about, open banking and what Flinx is doing and related to the changes within the lending space is I can see the sophistication that's taken place in capital markets around using data and technology to drive decision-making. We're really seeing that come to traditional banking now. So really exciting for me to watch and really exciting for Flinx and excited to be on the panel.
Great. Thank you. So before we talk about the future and what the future holds, I think the audience would be interested to hear what each of you learned about your business or even the market segment that you guys operate in during COVID. So Wayne, maybe I'll have you start off.
Sure. Yeah, happy to talk about our COVID experience. I can certainly say, and probably true for others on the call, that it's been a wild ride the last 12 months. So 12 months ago, or a little bit, 14 months ago now, when COVID happened, we were still an independent growth stage company. We hadn't been acquired by a firm. We weren't part of this multi-billion-dollar company. And, middle of March last year, we were freaking out, right? Like we thought delinquency was going to go through the roof in our portfolio. We thought retail sales were going to go off a cliff. We thought our funding sources, our lenders were going to freak out and cut us off. So we went into a very, very defensive mode very quickly, kind of last mid-March, and kind of prepared for this, white knuckle ride. And what was interesting is how quickly it all blew over for our business model. So number one, delinquency didn't even budge. It actually got a little bit better. Number one was there was obviously the Canadian government support, but number two, people were just spending less. People were at home. They weren't filling up cars with gas. They weren't going on trips. They weren't at restaurants. And so we'd prepared this whole payment deferral plan, which we didn't even really need to use. Like 0.5% of the borrowers used it. The second thing was after a few weeks, our lenders got comfortable. And then the third thing, which was, the most relevant and exciting for us, is what happened in retail sales. So our business before the crisis was half in-store, half online. The last couple of weeks of March, the in-store dropped off almost to nothing. So we were saying, uh-oh. And then the e-commerce piece took off, and we ended up significantly higher than we were before, 90-10 e-commerce to in-store. And so this huge online shift of consumer behavior to online shopping was massively beneficial to us. And so we were very fortunate to be geared toward e-commerce and to be in the categories that consumers were moving to. So home goods, right? Like fitting out the home office at Wayfair, new laptop and gaming stuff from, Samsung or what have you, or new Bowflex equipment or Peloton in the firm business. So we ended up having a COVID experience that was extremely positive in the end after this like really stressful starting point. And then later on in the conversation, I can talk a little bit more about how that led into the M&A that we did. I actually believe COVID was a catalyst in the M&A process that we went through. But that's a little snapshot of how COVID affected us as a buy now, pay later provider.
Great. Andrea, do you want to provide a bit of an overview?
Yeah, for sure. And I'll definitely build on some of the points that Wayne made. So, I think for us, when we look back at the year, the biggest theme across our customers, our business, and our employees is definitely resilience. We've spent a lot of time talking about resilience and using that word. To echo Wayne's comments on the customer side, what we really saw from our customers was such great resilience. We've seen some of the lowest delinquency rates in our business and the company's history. And I think a lot of people didn't necessarily share that understanding around non-prime consumers and thought the second we would have any economic downturn, those would be the people that would be most effective. And we frankly saw the opposite. So, expenses were reduced and people were making their loan payments on time. And, we definitely saw that reduction in delinquency rates. So that was great to see. So definitely saw that side from the customers. On our employees, we've got 2,200 employees. We had, field employees that were deemed essential services that were still working in the field across the country. We had a support center that we had to send home. We had a call center. And so all of the ways in which the employees adapted, whether it was, safety protocols in our stores and branches or working from home for our support center, it was absolutely amazing to see how that transition happened so quickly and how adaptable everyone was. And, notwithstanding, some of the issues that we're seeing around mental health and how much, people are working and what that kind of work-life integration looks like, for the most part, people have been just incredibly, incredibly resilient and, grateful to be employed and grateful to be a part of an organization that's really kind of taken care of their people. Early on in the pandemic, we made a commitment not to lay off one single employee, and we've kept true to that promise. And so that's something that we're quite proud of as well. So seeing that resilience in our employees has definitely been great. And then when it comes to our business, we've had probably one of the most successful years in the company's history, for sure. There's a couple of components to that. One is definitely the delinquency rates that we've seen, which have been positive for the business overall. One of the things that I didn't mention in my introduction is that we have an amazing partnership with a firm, and we've been able to benefit from the growth in the point of sale channel. So that's been absolutely fantastic for us. We've been able to acquire new customers through our point of sale sale channel. In addition, we recently completed an acquisition of LendCare to further grow our point of sale channel. So we've seen some really, really good momentum there. Lauren spoke a little bit about culture on the people side. It's really made us think about how we think about our people, how we think about work-life balance, how we think about mental health in the workplace. We've been able to introduce some incredible programs, free virtual healthcare, mental health resources, and a whole bunch of other things. So I think when I take sort of the view from the customer, the employee, and the business, it really comes down to resilience. And, to echo Wayne's comments, like March of last year, I don't think we ever could have imagined that we would be sitting in the position that we're in today. So really, really proud of the team that we have at Go Easy and the way in which everyone has really pushed through and adapted to the circumstances.
Right. Clayton, you're next on the line.
Sure. So, probably similar experience to everyone else where kind of March and April of last year, there was kind of a sudden halt and a lot of uncertainty. We saw that. I think with Flinx, we have a unique position where we're almost like an index or a bit of a proxy for financial services activity because of the diversity of our client base. So it was interesting to see certain segments and how they performed differently to others. But after the summer last year, things really started to pick up. We got calls from a lot of businesses that we hadn't spoken to in the past that we're now sort of wrestling with how do they digitize. And so for us, the period of time, I mean, obviously there's a long-term trend of digitization going on that in our view is powered by data, but I think COVID's just accelerated that. And so fortunately, it's been a nice tailwind for us. I think gone are the days of, paper forms and in-person meetings. We're just, having conversations with clients all the time around how they can digitize their processes, and it's leading to new innovation, which is fantastic. So I think notwithstanding a lot of the negative things that have taken place over the last 12 months across the board, both from a business perspective and for many people from a personal perspective as well, I think there is some good and positive that is coming out of this. We're already seeing that in spades.
Thanks, Clayton. It made me smile because being the only person from a bank here, it made me smile when you said done other days of where we do everything on paper. But let's move on. Lawrence, just to wrap up on this, like, what did you learn during COVID?
For sure. And it's so refreshing to hear everyone's perspective. And I think what's interesting is that we've, although we kind of live in different segments of the consumer finance space, we've all had such similar experiences. I'm not sure if you guys noticed, but my neck has been nodding the entire time. Everything from the concern around delinquency rates. I mean, Wayne, we went through a very similar experience. We had a deferral product ready to go, which we never ended up launching because our delinquency actually improved to our surprise. Everything around resilience, Andrea, that you mentioned, we saw it across the boards, right? From our lenders and funders who stepped up to make sure that they were there to support us, all the way through our employees. So very similar experiences across the board. Instead of boring everybody with repeating the same thing, why don't I talk about changes we've seen in consumer behavior and how that's kind of changed our business. One of the things that I think is interesting is we noticed a change in customer service call patterns. Normally, we'd have about 40% of our call volumes happening outside of business hours. So before 9 o'clock in the morning, before people go to work, and after 5 o'clock when they get home. And that number has reduced from 40% down to 20%. We're receiving over 80% of our calls during the day. And for us, the insight that we kind of gather from that is people are just becoming more comfortable having a blended work schedule where, we're not really sticking to that 9 to 5 regimented work schedule. We're finding pockets of time to do personal things, and we're also working outside of that 5 o'clock timeline. We've also seen a huge shift towards online chat-based support, customer service, self-service tools, online tools. Customers are just becoming a lot more trusting and comfortable with that. And I think probably the biggest change we've seen, which I believe will persist past COVID, and Clayton kind of touched on it a little bit, it's it's the comfort that our customers are having with a digital sales process. And for us, a bit of insight that we get, we rely on a dealer network that traditionally transacts inside the home, right? So, we call it a dining room table sale. And what we've seen is, an all-time high level of transaction volume coming through our digital channels. We're seeing larger ticket items. We're seeing a wider array of products. And the interesting thing is, not only does that kind of tell us a bit about consumer behavior and consumer trends changing, but it's also showing us that our dealer network is starting to change and adapt to this new world. Our dealer network is traditionally, kind of old school, less willing to adapt to change. They're more paper-based, and we've seen them really embracing tons of digital solutions. I think, quickly, just from a macro standpoint, most people are moving out of multi-unit residential and looking for bigger homes, larger backyards. So we've seen a huge spike in new construction sales. That line of business for us is up over 30% of where it was in 2019. And we've also seen something I think is super interesting, a 12-fold increase in spending related to discretionary items. So things like pools, hot tubs, jacuzzis, are up significantly. And then we've also seen essential services, things like HVAC and roofing, up over 40% against this time period last year. So a lot of interesting insights. Happy to dive deeper during the Q&A, but I think we've all kind of echoed our experiences here.
Yeah, thank you. And the lens from a customer perspective was very insightful. So good you touched on that. I want to turn the discussion now towards the future. So now with the eventual opening up or reopening of the economy, as well as the recovery that will follow, which will result in a pent-up demand coming out, how is that expected to impact lending demand, and how do you see that accelerating your business or growth of your segment? So maybe Wayne, should we start off with you on the buy now, pay later segment?
Sure. Yeah. So, I guess it's obvious that the buy now, pay later segment is heavily driven by consumer spending, consumer retail spending. And I think our perspective is that the consumer is ready to spend in North America, and to spend in some areas that they haven't been. So the U.S., a firm had an earnings call a couple of days ago, and one of the major topics was the resurgence in travel and recreation spend. It's sequentially over one quarter to the next increased a lot, and I think it will continue to. And that's an area where buy now, pay later has had a pretty big growing penetration. In terms of changing spending patterns, my view is that we've had this big rapid shift to e-commerce spending. It will normalize a little bit as stores open, but it will never fully snap back to the way it was. We've just taken a step change forward in the evolution toward online spending. So that's I guess a plus for buy now, pay later providers, that where the product tends to work quite well for e-commerce. But our strategy is to make sure we have the right answer for in-store as well, and to make sure we have a truly omni-channel offering available for retailers coming out of this. Even though e-commerce is the highest growth area of retail, the most retail sales are still in store, and it will still be like that for a long time. So we're leaning into right now a lot of our omni-channel offering to make sure we have a joined up experience online and offline for merchants. We just announced yesterday our partnership with Fiserv, where PayBright's available on the Clover terminal. And all of this is geared up to making sure we're ready for that in-store resurgence. That even though in Ontario, anyways, it's been delayed by a little bit, it is coming. And so, yeah, so those are some of the trends coming out of COVID that we're thinking about.
Great. Andrea, from your perspective and on the subprime consumer side, how do you see the reopening working?
Yeah, I mean, I think I would just echo a lot of Wayne's comments as well. The best analogy that I heard is, we can expect sort of the roaring 20s and that phenomenon that was seen after the global pandemic in the 1900s. And I think you're starting to see that as well. Many people are booking travel, to Wayne's point, and looking at it and starting to think about how they're going to spend and what they're going to spend on. So the increase in consumer demand is definitely something that we're looking forward to and that we expect to see. So that's definitely a big piece. And then again, again, just to piggyback on Wayne's comments, we operate an omni-channel business, and our philosophy has always been for lending to the non-prime consumer, it's best done in a face-to-face setting because there's complexities about the product. Being able to look somebody in the eye and explain it to them with full transparency and ensure that they understand everything about it is really, really important. We've always operated under that model with some level of digital integration. Well, fast forward through COVID, we really had to pivot our use of digital technologies and basically integrate that to a much more significant level than we've had in the past. And so I think for us right now, the big piece is really thinking through that entire omni-channel journey for the customer. And whereas pre-COVID, it might have been a little bit slower in terms of how we were looking at that journey, COVID has definitely accelerated our view of what a full digital branch-based interaction for our consumers look like. And so that's probably the biggest nut that's ahead of us and that we're looking to crack over time.
Okay. So Clayton, what new areas of services or from a technology perspective are you like really excited about, and how do you guys see yourself expanding in that segment?
Yeah, so we've seen a lot of innovation in kind of three areas. Like one is what I mentioned around digitization. So just the idea of taking existing processes and decision making and having more data and technology drive that. The other, which was mentioned by a couple of my panelist peers, is from the customer point of view, thinking about unique and innovative customer experiences that can be designed through data and technology. And the third might be actually new products and services that are driven by data and technology. So Flinx provides connectivity to an individual's financial data, but once you have the data, there are so many amazing things that you can do with it from an analytics perspective. If I think of the lending use case, for example, if I could tell you like a prospective borrower's income, so over say like the last 3 months and the sources of that income, whether it's an employer or government, like what other loans do they have, what payments are they making there, the number of NSF checks, like or NSF issues that they've had in their bank account over the last couple of weeks. Like all those items are like data nuggets or nuggets of insight that are buried within someone's transactions data with their financial institution. So if you're able to surface that and you're smart about like what pieces of information you want to draw from it to power your model, you can get all of that information in literally like one click. And so if that's kind of the new sort of paradigm we're operating in, you think of what you can do with that and how you can redesign some of your customer experiences around that. To us, that's really, really exciting.
Great. So maybe we should pivot towards acquisition and M&A, and significant number of you on the panel have either been part of it or have completed significant M&A transactions over the last 12 months. So it would be interesting to hear perspectives on some of the opportunities as well as the challenges that kind of COVID presented in executing these opportunities. So maybe we'll start with Lawrence.
Yeah, sure. I'd be happy to kick us off. I think we've got an interesting and rather unique perspective when it comes to M&A. You guys may know we're highly acquisitive. We've completed 13 transactions since inception, and some of our most notable ones happened during COVID. What are some of the challenges? So personally, one of the biggest challenges I had to face was raising capital and going through the full M&A process in a digital format. No whining and dining, no face-to-face interactions, no face-to-face interactions with our equity sponsors or even with the target company that we were going after. Imagine conducting diligence remotely. It created a lot of unique challenges that we've never been through. Funny enough, it's been 7 months since our acquisition, and we're yet to see some of the office spaces that we've acquired. We are yet to meet face-to-face some of the 200 plus employees that are now part of our family. So I'm sure you guys can appreciate, like, these have created new challenges specifically around things like culture and change management and business integration in general. But nothing that was insurmountable. On the flip side, I found that operating digitally while raising capital actually expedited the process, and it cut out a lot of the noise and the distractions that are normally a part of raising money. The sponsors that we ended up working with were really focused on the fundamentals and less on the qualitative aspects of the transaction. One of our lenders said to us, it had to make sense if it was going to make dollars, and I thought that was pretty funny. Post acquisition, going through those challenges, it forced us to invest time, energy, and resources into documentation of processes and systems, and ensuring, most importantly, that we were communicating and sometimes over communicating through things like constant town halls, a lot of one-on-ones. We developed very clear and actionable KPIs with a defined feedback loop. So that was kind of our personal experience. But if I look at, the evolution of the broader M&A market, liquidity and activity during COVID up until now, I think it actually resembles, somewhat of an inverted bell curve. That, as you emerge from the trough down here, it actually ends up way better off than when it started. With more liquidity and more activity happening in the market now than pre-COVID. And I'll tell you guys about kind of the experience we had raising capital. When I look back at March 2020, we felt in the marketplace there was this like sense of apprehension, and really that was driven by this global state of uncertainty. So much so that we actually lost our first group of investors, both debt and equity investors. We lost them on the Snap Financial transaction, and we had to back out of that deal. The fortunate thing for us is not only did we lose our funders, but the entire capital markets dried up. So that meant that nobody was raising money, and it was a function of time for us to get back. What was interesting, and I think Wayne mentioned this earlier on. What was interesting was how fast the equity market rebounded. It took the Dow Jones 126 trading days to rebound back to the record highs of February 12th, and the fastest rebound in history. And we felt that rebound early as well. And a lot of that, as Wayne mentioned earlier, was due to government stepping in stimulus packages, and with interest rate cuts down to almost zero levels. At the end of all of it, we were really fortunate to get our deal done. We ended up getting out of the process on better terms than we initially anticipated, with 2 other transactions that were follow-up deals. What we noticed was, as the markets turned back on in May, investors were putting money in, but they were cautious. They were really looking at the fundamentals and spending time understanding the businesses. But as it escalated, like by the time we were done our deal, which was August, September, we'd seen this material shift in their approach, and it became more aggressive, more confident, more opportunistic. We found that the equity markets looking for companies that could be acquired at a discount, because of the impact of COVID. So, that in addition to, the excess of capital in the market, I feel like, there was a point in time early on during COVID where there were a lot of good deals out there, but I think because of those things, the market is starting to look frothy now. Valuations are starting to get to, all-time highs and resemble, the pre-COVID days. And I feel like, if any folks listening in are looking to engage in M&A activity right now, there are always deals to get done, and there are always deals out there. But the discounted deals are it seems like they're few and far between. There's a high demand for deal flow and not that great supply of companies. And we're starting to see people looking at inflated forecasts and adjusted EBITDA multiples and things that weren't being looked at during the scary times of COVID.
Thanks, Don. Congratulations. I mean, this is just remarkable that in this environment, you've managed to complete so many significant acquisitions.
Appreciate it. Yeah, no, it was a ton of fun.
Yeah. Wayne, over to you. How did the integration go with the firm? And actually, to what brought on that would be interesting to hear as well.
Yeah, I can sort of pick the story up from where I was describing earlier. So we had the white knuckle experience where we thought everything was going to hell in a handbasket, and then the switch to realizing that things were going pretty well. And it turns out most of the buy now, pay later players kind of had a similar experience, whether it was the firm or Klarna or Afterpay. And then everybody was sort of realized by sort of April, May that they were sort of coming out ahead, and that buy now, pay later was gaining steam in this environment. And so in the springtime, starting in May, we started to be approached by several buyers, potential buyers of our business, both buy now, pay later companies that were larger than us in other countries, and some banks. And so we sort of pondered that for a while, and then decided that maybe this is something we should listen to. The conditions are right. There was a lot of capital flowing into this space. Installment lending and buy now, pay later was in demand. Canada was in demand for the international players that were looking to expand geographically. And so we sort of went through that process in the summer and early fall, and ultimately settled on Affirm as being the buyer that was the winning bidder, and the one that we were most aligned with. I'm not sure, to be honest, without COVID as the catalyst for everything, whether we would have done that. And also to Lawrence's point about equity markets recovering and the return of the froth, just after we closed our acquisition, Affirm was able to pull off a very successful IPO. So it's all sort of part of the same kind of trends in capital markets. The only real challenge we had was the same as what Lawrence mentioned. Is I've only ever met two people at Affirm in person. The entire deal was done like from my house, right? So we're looking forward to getting back together later this year.
Hey, congrats on that deal, Wayne. That was amazing to see. Both the one you guys got done and the Affirm one set a new benchmark for all of us. It's great to see.
Wait, maybe just one follow on from an integration perspective, and I know everything's remote and stuff. Were there any challenges? Anything you can speak to you would have learned?
So I think it's going quite well, all things considered. And I think it really helps that we have very similar business model and culture to Affirm in terms of how we think about the product and just the style, the people's style, and all those things that are really important to making an acquisition work. So I think it's gone really well. We've been very happy with it. I think it's just, again, building on what Lauren said, to build trust and relationships over Zoom, you've got to over communicate and lean in, and what all those hallway conversations that aren't happening and all those casual social events that aren't happening, you've got to make something happen really intentionally, and it just takes a little longer. So I think that's probably been the main challenge, but we're getting there. I just think it's going to take a little longer for everyone who is a PayBright employee to feel truly connected to their colleagues when it's over Zoom.
Thank you. So that's the end of the formal part of the panel. If anybody has questions, there's a Q&A pop-up box that you guys can put your questions on, and I'll try to direct them to the most relevant panelists. So while you guys do that, there's one that's come up, and it's got to do with payments and disbursements. So maybe, I'll keep you there. But the question is, how important is the real-time payments disbursements to your line of business? And in your case, I guess the vendor, right? Like, are you really seeing that part being more significant than it was pre-COVID?
Yeah, that's a good question. I think there's probably a couple layers to that question. So currently we fund the merchant the next business day, unless we're funding via virtual card, in which case we fund sort of on the normal timeline that they would get funded through their normal credit card processing. So that used to be what we called close to real time. I think with the upcoming eventual release of the real time rail in Canada, where you're going to have like settlement in minutes or seconds, we will be on that as quickly as we can be, because the sooner we can get merchant partners their money, the better. So, it used to be competitive to disperse money within a week, then it was 3 days, now it's next day, and soon it'll be same day. That's our view.
Yeah, I want to add to that, if I can. I think we've seen something very similar. We rely on the network for our origination volume, and that dealer network is diversified all across the country in various verticals, but ultimately all in the home renovation space. And what was critical for us, and a big part of our kind of mantra as we emerged from the early stages of COVID was making sure we put that dealer first, above and beyond everything else. And what that meant for the dealer was making sure they could trust us. And the best way to show them that they could trust us was get them paid as fast as possible. Our dealer network went through a lot of their normal support systems letting them down. We've had supply chain issues with products entering in from overseas and from the United States. So that became an issue for our dealer network. We've had the government put restrictions around areas that they could work in and could not work in, right? So our dealer network has gone through an extremely, extremely challenging time. And we've done everything from, pay faster than we normally pay to we've had certain dealers where we pay in advance of an average of what normal monthly volume would have been, right? So there's an advance payment there, knowing that this dealer is gonna be with us for the long run and has been with us for the long run. So I think I echo your sentiment around your vendor network. For us, it's all about getting that dealer paid ASAP.
Great. A lot of questions are popping up on delinquencies and the fact that with all the government money that's in the system today, both for companies as well as consumers, at some point that's going to go away. And on the flip side, demand's going to open up, right? So this balance in terms of higher demand but higher delinquencies. How are you guys preparing for the increased demand and then the rise in delinquencies? So maybe Andrea, I'll direct this question to you.
Yeah, so a couple of things. I think, one is preparing for the increase in demand for us is making sure we've got enough capital and liquidity to be able to support that, which we've been able to secure over the past year based on the market conditions that both Wayne and Lawrence have spoken about. So we definitely feel good about that. I think, look, the things that drove lower delinquency also drove lower demand, and you're going to see that rebalance a little bit as you start to see that growth come back. You will see some of those charge-off rates increase slightly, but we think that it won't be to the place where it was, 12, 14 months ago, and it'll be more of a balanced view that we have across the portfolio. But that increase in growth will help to offset that for sure.
Anything else to add, Wayne?
No, similar view. I think we can move on to some of the other questions.
Okay. So Clayton, there's one that's come for you specifically. So what are some of the most interesting or unanticipated uses for deposit account data that you've seen or discussed with potential clients?
Yeah, I mean, there's more and more every day as we kind of uncover what different use cases you can power with the data. But to me, there's a ton of potential in learning more about your customer. So I think that all of our customers are now starting to use data to power their processes, which is great. But to me, that's only the first step. There's so much more that can be done. Like, we're very early innings. If you think of marketing opportunities, cross-selling opportunities within your customer base, you can be so much smarter about the way you service your customer and what other potential offerings you might be able to develop for them just by learning about who they are. We all know that Amazon and Facebook and big technology companies learn about what we do through our browsing activity, and sometimes it's without our consent. This is the opportunity to learn about a customer through their financial data, their financial activity, with their consent. And that's either an individual or a business. So to me, kind of the most interesting opportunities for the data and technology space, kind of open banking, or how that might power lending or financial services more broadly going forward, is really around the opportunity to learn more about the customer.
Thank you. Just taking it into a different direction. So a couple of questions that have come up on Bill C-274, which I believe lowers the interest rate from existing threshold. So the questions are around, like, what are your views on it? And in addition to that, have you guys seen higher scrutiny from regulators during COVID as part of that process? Maybe Andrea, again, I'll start off with you, and then Lawrence, if you can add on to that as well.
Yeah, I'm happy to comment on it. So a couple of different pieces maybe that I'll unpack around it. So, we've spoken a lot about this, and the correlation between interest rates and access to credit is quite strong. And we fundamentally believe for our customers, being able to get into a product that helps them rebuild their credit and actually keeps them away from payday loans is highly, highly beneficial. And so when you start to talk about changing that rate and lowering that rate, we've done a significant amount of modeling that shows, how many hundreds of thousands of people you would actually shut out from the credit system and force into undesirable payday loans. And that's something that we want to avoid for our customers. So that's kind of, the first piece there. From a business lens, we had our quarterly results this week, and we talked a little bit about our weighted average interest rate, which continues to come down for our business. It's sitting at about 37.5%. And so, from a business impact standpoint, we've modeled this out, and the impact, is manageable throughout the business, but it's really the consumer side of things that concerns us the most, because we've spent so many years now just trying to help that consumer, trying to graduate them back to prime rates. 60% of our customers rebuild their credit with our products, and we know that immediately goes away if they're pushed into payday loans. And that's fundamentally the biggest thing that we're trying to avoid.
Yeah, I once again want to highlight a couple things, Andrea, that you mentioned there. I think there's an important place in our market to service customers that fall into that subprime category, right? And when you push those customers aside, you're not helping lift them up, and to Andrea's point, helping them rebuild their credit and get onto a better platform, right? From our perspective, we're probably not the best ones, Lila, to I'm probably not the best one on the panel to speak to this. We're in the prime and super prime space, right? Our average Beacon score is 742, right? So we play in a different zone. We're a 999 and less lender. So we're not as impacted as some of the other folks on the panel might be, but I totally empathize and agree with Andrea's sentiment around making sure that the customer gets put first, and that legislation is there to help support the customer and help them through whatever tough times they could be going through, and not kind of shun them out of the financial ecosystem.
Yeah, and just to follow on to that, I think it's got more to do with not specifically the bill and the interest rate, but the regulators coming in terms of protecting the borrower. So Wayne, have you seen anything in your segment on that?
Nothing significant. I think, buy now, pay later, the new generation of buy now, pay later, shall we say, is still pretty new in Canada. I think, one or two of the provinces have been sort of looking at it, seeking to understand it more. I think, the main thing about buy now, pay later is it's an extremely customer friendly product. The vast majority of it is interest free. The way that we conduct a business, there's, again, no revolving interest, no deferred interest, no late fees. So it's about as customer friendly a way of paying for something as you can imagine, and certainly more customer friendly than using your credit card. And so we're happy to discuss that at length with the market and any regulators that are interested. And while we do that, and while we have that product, we also have to comply with all the existing regulations around consumer disclosure and protection. So
I might, maybe I'll just add one other piece from our lens, which is, education as well, and just really helping people understand who the consumer is. I think there's a lot of misconceptions about who the non-prime consumer is. There's 9 million non-prime consumers. It's about a third of our population, so it's not an insignificant amount. And when we look at who our consumer is from a Go Easy lens, it's very much the average Canadian. Average age of our consumer is 40 years old, earning about $47,000 a year, and frankly have lower debt levels because they skew towards being renters. And so for us, there's a bit of perception around who a non-prime consumer is. And part of what we want to do is make sure we can educate people on who the consumer is and why this product serves a very, very important role in our ecosystem.
Okay, and it's an interesting thing you brought up on the perception, because a couple of questions, and I've heard it as well. I mean, the question here is there a perception issue around generally alternative lending or subprime lending? And especially in the times of COVID, and how are you as an organization kind of fighting that perception and trying to change that perception? So.
I'm happy to take that one. So further to my earlier comments, I absolutely think that there's not a lot of understanding, and probably the biggest misnomer that we've seen is the alternative lending space gets grouped into the payday loan space. And the products are so entirely different that educating just the general consumer population around why they're different and how they're different is really, really important. So notwithstanding rates, notwithstanding amounts that you can borrow, this notion that in order to improve your credit, you actually need access to credit and you need to take out credit is fundamentally misunderstood, I think, broadly speaking. And so for us, continuing to educate people on, first of all, the product and how it operates. Second of all, that correlation between access to credit and interest rates, which is really, really important. And then thirdly, again, who that customer is really, really important. And so, the category itself is relatively new in Canada, frankly, from an omni-channel model standpoint with a multi-product portfolio. There's not that many players. And so definitely that education piece, I think, comes into play. And for us, we've built this company on a very, very clear vision, and it's to help everyday Canadians improve their credit. And we stand by that, by the products and services we offer. And we stand by it, frankly, by measuring the improvement that our customers are seeing. And that's something that's super important for us. So the ability for us to help customers improve their credit so much so that they can borrow from a bank is fundamentally what we strive to do. So that's how we're trying to educate. And obviously being a part of the CLA is a big part of that as well, because I think as an association, we can stand together and really help ensure that that message is made clear.
Great. Thanks, Andrea. And we've got a last question, and these days there's no panel that gets wrapped up without a crypto question. So the question here is, do you guys see an opportunity for a digital product in Canada? So for example, like people would place deposit in cryptocurrency or purchase the item in the future with a cryptocurrency. So maybe, Clayton, you want to talk a bit about like if there's anything you're seeing at your end, and then Wayne, to you on if you see this coming up on the buy now, pay later side.
Sure. I don't think it's going to impact the industry dramatically in 2021, but certainly it's coming. You see, the ways in which crypto might influence the payment space. You think about the tokenization of assets and how those can be used when you think about different types of lending and insurance that might be available through blockchain technologies in the future. That's quite interesting. But there are still lots of challenges that remain. I think the anonymization of some of the transactions, the way people think about like refunds or reversal of transactions, which can be more difficult with certain types of blockchains. So it's definitely going to come and change the industry. I'm confident of that. At Flinx, we're keeping a close eye on how things are changing, but I don't think it's going to change things dramatically in the short term. Although that said, there are some fascinating things going on around the world with a whole bunch of different projects. So not anytime soon, but yeah, I think blockchain technologies are here to stay.
Yeah, I think I would echo that. We don't have anything specific to announce on that front, other than clearly it's a growing space and the underlying technology is interesting and has many use cases. Part of the question related to a layaway concept. I think buy now, pay later largely does away with the historical concept of layaway anyways, which is that because you get your product now, you get your service now and pay for it over time rather than having to make deposits and then get it later. So the concept of layaway is not what it once was. But yeah, nothing to add on crypto.
I think just want to add one thing. I think the interesting kind of development, and it's as relevant as today, was that I think we all saw that Elon Musk and Tesla initially began accepting Bitcoin as a form of payment for their cars, and today they came out saying that they're no longer accepting Bitcoin, and that's a function of the environmental impact of mining Bitcoins, right? So I think there's, to Clayton's point, there's definitely a use case, and but I think that there's so many things that need to be figured out, and processes and decisions that need to evolve. It's such early days that I don't think this is relevant even in the next half decade in a material way in the Canadian consumer finance space.
Yeah.
We've got to wrap this thing up. I can go on this topic for a while.
That's a good point, Lawrence. And one other thing I'll mention on crypto is like people have to understand that there has to be a large shift that's going to take place from fiat to crypto. So like that hasn't even started, kind of en masse. It's definitely started. Like Flinx powers a lot of crypto type platforms in terms of moving money across. But until we're in sort of that crypto world, we can't start lending and doing all the innovative things that we want to, and that's not going to happen until we shift from fiat.
Great, thank you, Clayton. So this would be the end of the Q&A session, and I would just like to thank all the panelists for taking out the time, their valuable time to spend with us and answer some of these questions and provide insights into as well as what the future holds. Danielle, I think it's back to you.
Great, yeah, thank you so much. Yeah, and thank you to all the panelists for your incredible insight, and to Leila for moderating such a great discussion. And thank you for everyone who tuned in and submitted questions. We invite everyone to become a member of the CLA and participate in the FinTech lending community. But of course, just continue attending our upcoming panels. You can find them at lendersevents.com. So thank you again, and I hope everyone has a great rest of your day.
Thank you.
Thanks, everybody.